Today, we're diving into a crucial accounting standard that every finance professional needs to master, IAS 10, events after the reporting period. Have you ever wondered what happens if a major event occurs after your company's year-end, but before the financial statements are officially released? Well, IAS 10 gives us the rulebook for exactly that. So, what is the reporting period? It's the period your financial statements cover, usually a year, ending on a specific date like December 31st, and the events after the reporting period are any events, both favorable and unfavorable, that happen between that year-end date and the date the financial statements are authorized for issue. This authorization date is key. It's the date management signs off on the final statements. Now, IAS 10 splits these events into two main categories, adjusting events and non-adjusting events. This distinction is the heart of the standard, and getting it right is vital. Let's start with adjusting events. These are events that provide evidence of conditions that already existed at the end of the reporting period. Think of them as new information about an old situation. Because the condition was already present at the balance sheet date, we need to go back and adjust the numbers in our financial statements. Let me give you a classic example. Imagine your company has a pending court case at year-end, and you've made a provision for a potential loss. After the year-end, but before the statements are issued, the court rules against you, and the final settlement amount is confirmed. This confirmation provides new, concrete evidence about a condition, the lawsuit liability that existed on December 31st. Therefore, you would adjust your provision to reflect the actual settlement amount. Another common example is the bankruptcy of a major customer shortly after the year-end. This often indicates that the customer was already in financial trouble on December 31st. As a result, you would need to adjust your allowance for doubtful accounts to reflect a now certain loss on their receivable balance. Essentially, if the event gives you hindsight about the true value of an asset or liability at the year-end date, it's an adjusting event. Now, let's talk about the second category, non-adjusting events. These are events that relate to conditions that arose after the end of the reporting period. The situation was brand new and didn't exist on your balance sheet date. For these events, you do not go back and change the numbers in the financial statements. For instance, suppose your main warehouse burns down in a fire in January, after your December 31st year-end. This is a significant event, but the warehouse was perfectly fine on December 31st. The fire arose entirely after the reporting period. So, you wouldn't write down the value of the warehouse in your December 31st balance sheet? However, just because you don't adjust the numbers doesn't mean you ignore it. If a non-adjusting event is so material that not disclosing it could influence the decisions of users reading the financial statements, you must disclose it in the notes. For the warehouse fire, you would describe the event and estimate its financial impact in the notes to the financial statements. Other examples include a major business acquisition announcing a plan to discontinue an operation, or a significant drop in the market value of your investments that happened after the year-end. There is one major exception, though, related to the going concern assumption. If an event after the reporting period indicates that the company might not be a going concern, meaning it can continue operating for the foreseeable future, then the entire basis of accounting changes. In this extreme case, you would have to prepare the financial statements on a different basis, like a liquidation basis, which is a massive change. So, to recap, events after the reporting period fall between your year-end and the date statements are authorized. We classify them as either adjusting or non-adjusting. Adjusting events provide evidence of conditions that existed at the year-end, and we must update our financial statement numbers. Non-adjusting events relate to conditions that arose after the year-end. We don't change the numbers but disclose material events in the notes. Understanding IAS 10 is essential for ensuring your financial statements are accurate and not misleading. It's all about providing a true and fair view. I hope this breakdown makes IAS 10 clearer for you.